Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we're diving into the world of driven brands, but buckle up because this isn't just another routine checkup. There's a major sale, a CEO shakeup, and some potentially risky financial maneuvering that we need to unpack. This Form 8K report from Driven Brands is dated February 25, 2025, so everything we are discussing is as of then. First, let's talk about a big deal. Driven Brands is selling its US car wash business. They've struck a deal with Express Wash Operations, also known as Whistle Express Car Wash. Basically, Whistle Express is buying Driven Brands' US car wash operations, which are run by a company called Boeing US Holdco. The price tag? A cool $385 million. That number might change a little depending on how much cash Boeing US Holdco has on hand, how much debt they have, how well their working capital looks, and some transaction expenses. This deal isn't done just yet. It needs to pass the usual checks, like waiting for the government to give the okay under antitrust laws. These laws are in place to make sure companies aren't creating monopolies that hurt consumers. There are also some standard promises and guarantees that Driven Brands is making about the car wash business and this whole sale process. Now, here's where things get a little more interesting. Whistle Express is planning to pay for this purchase through a few different methods. They're getting money from investors through equity, which is ownership in the company, and debt, which is loans. They're also getting something called seller financing, but about 20% of the deal depends on something called a sale-leaseback transaction, which is sometimes called a SLB transaction. So what is this seller financing? It's basically a loan from Driven Brands to Whistle Express parent company. This loan is expected to be $130 million, and here's the kicker. The interest rate starts at 13% per year, jumps to 15% the next year, and then 17% after that. Ouch. In that sale-leaseback deal, Whistle Express is selling some of the car wash locations they're buying to a real estate investment trust, also known as a REIT, and then leasing them back. Think of it like selling your house to get cash, but then renting it back from the new owner. Now, if Whistle Express can't close the deal because they can't get the money from this real estate sale, Driven Brands has the right to walk away. If that happens, Whistle Express will have to pay Driven Brands a $30 million termination fee, which is like a breakup fee. To make sure Driven Brands gets that $30 million if the deal falls apart, some big investment firms, Oaktree Capital Management and Alvarez and Marsal Capital, are guaranteeing the payment. These are called limited guarantees. There's a deadline for this whole thing. If the deal isn't done by November 24, 2025, either side can call it off. Once the deal closes, there will be additional agreements signed, including one about transitioning services, another about employees, and even one about using the car wash brand name. If you are interested, you can read the entire stock purchase agreement in Exhibit 10.1. Moving on, Driven Brands released their financial results. You can find the full earnings release as Exhibit 99.1. This part of the report includes a snapshot of how well the company performed financially, including key numbers, metrics, and insights. It will tell you if the company is healthy and growing, or if they are sick and dying. Now let's talk about a change at the top. The CEO, Jonathan Fitzpatrick, is stepping down in May of 2025. But he's not leaving entirely. He'll stick around as the non-executive chair of the board, so he'll still have some influence on the company's direction. Taking over as CEO is Daniel Rivera, who is currently the Chief Operating Officer. The company is also paying Fitzpatrick $750,000 to stay as an advisor through the end of 2025 to help Rivera. That's a pretty nice severance package. Fitzpatrick is also getting extra compensation for being the non-executive chair, so he's not exactly leaving empty-handed. To make room for Rivera, the board is getting bigger, expanding to 11 members. The company also issued 2 press releases, one about the car wash sale and one about the CEO change. Exhibits 99.2 and 99.3 have both of those. And finally, the usual stuff, some interactive data files to make it easier for investors to analyze the information. Before we get into some analysis and wrap things up, there is a cautionary statement regarding forward-looking statements. This is boilerplate language that states any statements about the future are educated guesses, not guarantees, and they depend on risks, uncertainties, and other important factors that may cause the actual results to be very different. Basically, the company is saying not to take their word as gospel. So what's the story here? Driven Brands is making a big move by selling off its US car wash business. This could be a smart move if they think the business isn't growing fast enough or if they need the money to invest in other areas. However, it's interesting that they are providing financing to the buyer at a pretty high interest rate and that the deal hinges on selling real estate sale-leaseback transaction. That adds some risk to the deal. If the buyer can't get the real estate financing, the whole thing could fall apart and Driven Brands would just get a $30 million breakup fee, which might not be worth the risk. Also, the CEO change is a big deal. It's always a question mark when a company gets a new leader. Will the new CEO take the company in a new direction? Will they be successful? The company is signaling confidence in the transition by keeping the old CEO around as an advisor, but ultimately the company's performance will depend on the new guy's ability. Overall, Driven Brands seems to be in a period of transition. They're selling off a business, changing CEOs, and taking on some financial risk with that seller financing. Whether these moves will pay off in the long run remains to be seen. As of their last report in December of 2024, without having detailed financials, it is hard to say whether they are healthy or dying. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe. Let me know what SEC filings you'd like me to decode next.